Good afternoon, everybody, and welcome to the 2024 Market Outlook. We are so happy that you're joining us. This is going to be a really, truly special event. We are fortunate that we have two visitors from the home office. We have Ryan and we have Sonu here. They are both market strategists, global strategists. They give us a lot of research. You know, we all do our own research. We gather together on a weekly basis. We compare notes. We look at the economy. We look at what's going on in the marketplace. And these two gentlemen are very, very instrumental in getting us intelligence that we can use. So we'll thank them. Sean will give you a more proper introduction. But as you know, we start all of our meetings with a prayer. So if you would, bow your hearts. Father, we thank you for this day. We thank you for the ability to get together. We thank you that our friends from Carson are out here and are able to give us some of their insights so that our people can share with that. We do ask that you protect our people, your people, especially those in the military, those first responders. Bring them home safely, whole in body, mind, and spirit. We do thank you, Father, that you loved us so much that you gave us your Son to die for us so that through our Lord Jesus Christ, we'll have eternal life with you. We pray that we'll be a little bit less unworthy as we go through the day, and help us to remember that it's all yours, and the clients to remember that they're just the stewards just like us. With this we pray through Jesus' name, amen. Okay, so what are we going to do today? We're going to have Sean, and we're going to let Sean introduce the guest speakers with their backgrounds. You know that Sean is our Wharton Wonk. His responsibility is to take all that research that we gather, put it together in what he calls the shizzolator. Some of y'all might think of that as an algorithm, but it's the Walker shizzolator, and that's how we come up with the different allocations and how we approach your accounts and how we invest your money. And these two gentlemen, Ryan and Sonu, are extremely important in helping us get the intelligence that we need to help make the results possible. Now, while Sean gets to take the lead with her upcoming presentation with Ryan and Sonu, remember that you've got 5 senior advisors here. You've got myself, Sean, remember Andrea, and then you've got Marcelo and Steve. That's on the investment side. You also, everybody has their own client care associate assigned to them for any of the operational questions, and every CCA has backup. So you'll never be left alone. Remember, we also have a very large tax department, and as we like to say often, it's not what you make, it's what you get to keep that counts. So if we can find ways to save you money on your taxes, we will also do that. So with that, Sean, I'll let you take it away.
Thanks, Bill. As you can tell, based on the great feedback that we got from all of you guys, which we really appreciate, by the way, we decided to continue along this vein, keep the round table intact, and keep doing something a little different every time we meet up with you. And today, I'd like to welcome two guests, Ryan Detrick and Sonu Varghese, to the round table, basically following the lesser-known 4th rule of thermodynamics, that if the heat is not on you, it's on somebody else. And these somebody else are guys who can definitely take the heat, given their credentials. Ryan Detrick is the Chief Market Strategist at Carson Group. Ryan is a chartered market technician, which means he's never seen a chart he doesn't love, and he can explain to the nth degree. Basically, if you recognize Ryan's face, you'll recognize him from CNBC, Fox Business, Bloomberg, podcasts, Yahoo Finance TV, you name it. He is dropping knowledge all over those channels, and we're delighted to have you. So thanks for sitting with us, Ryan. And right next to Ryan is Sonu Varghese. Sonu is the Vice President, Chief Macro Strategist at Carson Group. Did I get that right?
Global macro strategist.
Global macro strategist. I love Sonu because he is a PhD, mechanical engineering, is a quant guy through and through, and basically if you have any questions about the statistics that are being thrown down that we're bombarded with on a regular basis, you know, there are lies, damn lies, and there are statistics. Well, if you want to drive straight through that, you pick up the phone and you call Sonu. So guys, on behalf of Andrea, Bill, Marcelo, Steve, and the rest of the gang at AFP, thanks for coming out. So with that, basically the ground rules. Today is check the watch. I don't have the watch, but it's June 11th, which means by the time you're seeing this, we'll probably be wishing you guys a happy Labor Day. But basically, we're throwing this down because between now and when you see this, there's figuratively a month of Sundays. And that means in news cycles, oh my gosh, a lot can change in between now and then. So with that, we're going to give you the best kind of insights we can offer today. Ryan and Sonu have been kind enough, and I've got their little slide deck ahead of time. So this is their outlook for the second half of 2024. So they've been kind enough to share with us their thoughts. So this is always a moving target. So keep that in mind. So with that in mind, what we'll talk about is where we were 6 months ago, last time we sat down, and what the market did in between now and then. And then we'll get into the prognostications. I forgot my crystal ball, but we'll get into that in a minute. So anyway, guys, 6 months ago, where were we? We just finished a 2023 that was pretty good. And what were you guys thinking?
Well, you want to start? You want me to?
Well, I'll throw it off to you to start with. But 2023 was a good year, and as I always like to say, momentum begets momentum. It's based on a lot of the work you do.
No, that's right. And thank you for having us. This is fun. This seat's not that hot. I mean, you said it's the hot seat. I mean, I guess we're early though. We're early, Yeah. But no, last year 2023, we came into this year, everybody said it'd be a recession. Everybody said the bear market would be there. People were extremely skeptical. Fortunately, the work that Sonu and I did, we pushed back against that. And it wasn't always popular. Stocks had a really good year, up over 20%, and bonds had a strong fourth quarter to finish up, up a little bit as well. And I think the reason that happened was because expectations were just so low, and then the economy just surprised to the upside last year, really, right? As we came into this new year.
I'd like to think it surprised everyone else, as opposed to
That's true. That's a good call. Right.
I mean, but no, we didn't think there would be a recession, and we'll get into this, mostly because we thought the consumer will continue to be strong. I think everyone realized how strong the consumer was last year, and that's still our stance right now.
So right now it's a tenacious time for us as we see wars, we see elections, we see a lot of things, and we're getting into a bull market, right? We're how far into the bull market right now?
Yeah, so technically the last bear market ended October of 22. So this new bull market is what we're calling it, is about 19, 20 months old. And you think, well, that's a long time, up like ballpark 50% on the S&P 500, I should say. So what we hear all the time is, ooh, that's a lot. And yes, that is a lot. But the average bull market, if you go back to almost World War II, lasts about 5 years on average and gains well over 100% on average. Now, just because it's average, it's the old statistics joke. The statistician put his head in the oven, feet in a bucket of ice. He said, how do you feel? Well, on average, I feel pretty good. So there's no such thing as averages, but still, it's important to know with the macro stuff he's going to talk about, some of the stuff I look at. This bull market, Sean, is actually not that old, and history would say there could be a good deal of time and gains left.
Now, for everybody tuning in at home, a bull market is measured
I'll talk this one.
how?
If you go up at least from 20%, is that safe to say?
Off the lows?
Off the lows, everyone's got their own definition, but safe to say that's like the market definition. For somebody who's not totally into charts, I mean, he's more on that side of things. That's the definition I use.
And I would just add this. I mean, and that's a great point because everyone here is old. Usually bear market means stocks are down a good deal. Economy's probably not doing that well. Bull markets, usually when your clients are getting their statements, oh, that looks pretty good. And a pretty
I won't
good
call
mood.
him today.
Yeah, exactly. I mean,
I'm not going to call Sean today.
And technically a bear market's when stocks are down 20% from their high. Yes, someone a long time ago made up that rule. We had to make some line of demarcation there. But again, since October 22, things have been pretty good for investors, and that's why we're calling this a bull market.
Okay, so today, June 11th, 2024, you guys were on the plane, but when the market closed, or maybe you were getting shakes at the Shake Shack in Crystal Cove.
We were.
In Crystal Cove, the NASDAQ and the S&P 500 closed all-time highs. The Dow was up 40,000 not too long ago, and we have clients who may be getting a little fearful of heights at this point. And why shouldn't they be worried?
Well, the easiest way to put this Since 1896, May 26, 1896, when the Dow started trading. We've had 2 world wars, 2 100-year pandemics, inflation, deflation, lots of bad stuff, lots of scary things. The other thing, Sean, we've seen every time is the market's come back to new highs every single time. And what does that mean, right? That's what we're showing here. There's been a lot of new highs on the Dow since 1900. The exact number is over 1,400, give or take. The average return, Sean, after the market, this is the Dow makes an all-time high, is actually better than average. Not by a ton, but everybody thinks, oh my goodness, 2000 was a major peak, 2007 was a peak, 87 was a peak. Yes, those were peaks, and then bad times happened after. But if you look at history, you can have a lot of new highs take place, and new highs just by themselves are not something to be extremely worried or concerned with. Of course, we'll find a time to be worried, but we just don't think that time is now. I mean, do you agree there?
No, exactly. I mean, for the Dow or the S&P 500 or the NASDAQ to get to a new high, that means it went through another old high. And new highs beget new highs, right? So it's momentum.
I mean, it's only not going to happen once, right?
Right,
and,
exactly.
And you don't see that on the horizon at the moment. So basically, volatility. We had the pullback off of the 40,000, the Dow 40,000. And we've told our clients this time and time again, and you guys actually annotated this in last time's slide, where you're going to get the pullbacks. 5% happens, 3.5 times a year, or something like that, and then 10% a couple times a year, and so it's volatility is the price you pay to be invested in a good asset. So, that's we expect that.
There is some risk, but that risk is short-term volatility.
I mean, as good as last year was, stocks gained over 20%. There was a 10% correction from July 31st into October, late October of last year. You think, oh, the stock market did great. There are a lot of scared people, and what we talked about then was, listen, most years tend to see a 10% peak to trough correction. Just imagine right now if that were to happen. I mean, I like to use the Eisenhower quote, plans are useless, but planning is everything. We're not saying plan blindly for a 10% pullback, but most years see it. So just be aware that that could happen, and how is that going to impact someone when the screen is red and all the bears are out there talking on TV. Most years tend to see this, Sean.
Sounds like a great buying opportunity. So speaking of potential buying opportunities, I don't know if you guys have heard, we're having an election this year.
We are.
Which one?
That's right. We tend to be U.S. only. But I mean, we have, what is it? We just heard about, what is it, France?
The European Parliament elections.
Yeah, massive swings in control of power. So
Mexico, India, all of that.
No, gosh. So a lot of volatility. So when our clients, and some of our clients tend to skew towards one worldview or another, and it's either the sky is falling or the sky's falling, as it seems, regardless of where you're at. What do election cycles tell us?
There's a lot of ways we can go into this, and we will. I think I'll put it this way, though. How the economy is doing matters a lot more than what's in Washington right now, whether it be the makeup of Congress, who's in the White House. And I know that is hard for clients to do. We say separate your political beliefs from your investments, and we understand that's not easy. In 2000, well, let's just say, how do I start this? President Obama, a lot of people didn't like President Obama. Stock market did very well. A lot of people didn't like President Trump. Stock market did very well. People now like President Biden. Stock market's flirting with all-time highs the time we're doing this. So that's important to remember. But one of the other things when we came into this year, 2024, we said, listen, it is an election year, but it is a president up for re-election. That's what we're kind of showing on the slide here. When you have a president up for re-election, Sean, the last 10 times, this is going back again to World War II, the S&P 500 was higher every time in an election year if the president's up for re-election. 2000 and 2008, 1960. Those are the 3 years. The stock market was down with the president up for re-election. I'm sure with the president, but it was a lame duck president is what I'm saying. That's what we're showing here. The second half of the year tends to do a little bit worse, a good deal worse, if you have a lame duck president versus a president up for re-election. And we've had some really smart guests on some different things that we do. So yes, Washington can goose the economy a little bit. They can push certain levers to get people in a good mood, potentially to get the stock market up. We're not like, tinfoil hat guys here, but we do think there's some potential for that. So just be aware when a president up for re-election, market tends to do just fine. And this year's been playing out like that, to be honest.
The interesting thing is that no matter what in 2028, it's going to be a lame duck president.
Yes. We just talked about
well
that
said.
the other
Well
day. Yeah,
said.
no, absolutely.
Very interesting. So what stops a bull market? It's a recession?
I think something I'll draw from a thread he brought up. I mean, it's about the economy at the end of the day. I mean, you could argue even elections are about the economy, but especially for markets, it's about the economy. Why? Because why do we talk about a lot about the economy? Why do we follow it? Because that's where profits come from, right? And profits drive markets at the end of the day. Over the short term, you can get swings, you can get sentiment swings. People are more optimistic, less optimistic, but at the end of the day, it's about profits. It comes back to that. If the economy is doing well, profits are going to grow. If the economy is going into a recession, profits go down. That's when we worry about a bear market.
Yeah, I think I heard you say this on your podcast when you were talking about, April was an interesting month. A lot of stuff was going on in April. We saw not a minor correction, but we saw a pullback in April, and then what happened in May? I think you said
things came back.
Yeah, things came back better than expected earnings.
And I'll just chime in on May. So we did have a mild pullback in April, about 5%. And then May came soaring back, Sean. May, the S&P almost, not quite, but almost gained 5% in May. We took a look.
That's a big May.
That's a big May. May is usually not that great of a month. And when you gain at least 4% in May, I found 10 times, 10 times. June actually does really well. June's not that great of a month, but what got me was the rest of the year after a solid May, like we just saw in 2024, the rest of the year is up over 10% on average and higher like 8 out of 10 times. What in the world does that mean? That is a lot better than your average year the rest of the year. So is there, this is my little joke I've used on TV, maybe there's a clue from May. See how I did that? Maybe May. Yeah, anyway, yeah, I can do this all day. But
Sounds like a dad joke.
Yeah, I've got a few of those. But nonetheless, that's something. Just put some context around the fact that listen, we've had a strong May. And one more quick comment on this. Election years, we talked about those a little bit. We're going to talk a little more. I know clients are concerned about election years. You tend to see a summer rally, May, July, June. Those months tend to be pretty strong in an election year. And normally the summer months are kind of just blah. So just something to tell you what I think about this year.
So right now, we're about to, with the billions of dollars that are about to be spent, telling us how bad or how good the economy is, or just one way or the other, just trying to, you guys have a proprietary indicator of where recession is or where the economy is. Can you walk us through that?
How long do we have?
We have dinner reservations. Yeah.
No, look, we get a lot of economic data thrown at us, right? You get retail sales, auto sales, industrial production, payrolls, wage growth, all of those things. And it can be hard. You can get whipsawed. You can get whiplash going from one day to another. One day everyone's positive about the economic data. Another day, oh my God, things are going to end, right? And there's survey data, there's hard data, all of that. You're like, okay, how do we put all this together? Well, this is how we put all this together. We have our own proprietary leading economic index. There are other versions a lot of people on Wall Street use. We created our own because it's sometimes nice to know what's under the hood of these things, right? And so, for example, he asked me, like, why did the economy go into recession last year? It's right there, the blue bars that you see in 2022. I don't know if you can notice, but if you stare at it for some time, I think it'll hopefully show up. Look at 2021, 2022. Those blue bars represent consumption. U.S. economy, I would argue the world economy is driven on U.S. consumption. That's what the blue bars show. The consumer is healthy, and that's what kept the economy away from a recession, despite headwinds. Now, what are the headwinds? The green are financial markets. That was driven by the Fed. The Fed was increasing interest rates, right? We had a big shock in a sense. We went from 0 to 5% in a matter of a year, just over a year. And then because of that, business activity and manufacturing activity pulled back, right? Those are the gray bars. And then housing. I mean, housing is essentially how interest rates immediately get into the economy because mortgages, right? Suddenly, if I own a house, if you own a house too, my mortgage is about 3%. I got lucky with that. But then somebody who was trying to buy in 2022, 2023, suddenly they're looking at 6, 7% mortgage rates. Like, wait a minute, I'm not going to buy a house now. But what's interesting right now is those things are becoming less negative. As we go into the rest of, we are talking about an outlook as we go into the rest of 2024 and even into 2025, those things that were a drag on the economy in 2022 and even parts of 2023 are becoming less of a drag right now. That's what this is telling us.
So basically what we've seen is we see a lot of volatility. You've got, obviously you bake in some COVID issues
Sure.
in there, and then inflation and overreaction to inflation, alleged overreaction into inflation. And you see all that, but where does that put us right now?
Right now, what the dark blue line, I think it's blue, I don't know, I don't think it's actually black. It's telling us that the economy is growing on trend. So I would say the US economy right now is growing around between 2 and 2.5% real GDP growth.
So your contention is that despite the unbelievable barrage of media that we're going to be on the receiving end of, there's stability out there.
Yeah, just look at our indicator.
And I'll just chime in on this indicator, something that's interesting. So there are other leading economic indicators out there, like Sonu said, we've got ours. A lot of them were saying, again, early 23, we were like, they were saying we're in a recession. A recession is imminent. The data that Sonu produced here never said that. And believe me, we can get into the weeds of it, but one of the big reasons we look at hard data here, what people are really doing versus some of those other indicators look at what we call soft data like surveys. Hey, how do you feel? Well, this is one of the first times we've ever seen in history where people don't feel that good. Consumer confidence is low, people don't feel that good. But then if you look at retail sales is strong. Go to any airport, go to any steakhouse. People are out there spending and consuming. So I don't have the perfect answer for why people say one thing and then do another, but we have focused a lot more on hard data versus a lot of other places. And obviously, given the economy did really well last year and the stock market did, I think we're going to continue to focus on that hard data versus soft data.
So I'm glad you talked about consumer. So let's concentrate on the consumer. It's what, 60, 70% of our economy altogether. Let's talk about the incomes for a second, because there's no shortage of news stories out there that are talking about the $20 carton of eggs and the milk and everything that you see in the grocery cart isn't getting you as much as it once was, and the consumer is feeling bad. Really, what is the data telling you about how much they're earning?
And there's no denying that, right? The inflation was real, right? Prices did go up, right? In fact, depending on everyone's favorite metric of inflation, consumer price index or anything you see on the internet, or what the Fed follows, which is something called the personal consumption expenditures index. It's from before COVID, so February 2020 up until April of 2024, prices are up on average, they're talking about everything in the consumption basket, about 20%. But incomes, when you're talking about the stock market, we're talking about then the aggregate economy. When we talk about aggregate income, what does that mean? Incomes across all workers in the economy, right? That grew about 24, 25%. And that's essentially what the chart on the left shows. Incomes have actually outpaced inflation, which means there have been real income growth. But then there's another argument, wait, there are only a few people.
Well, let me jump in. Yeah, I mean, so Sonu, we hear that, but then we hear, well, listen, that's the top 10%. Top 10. The other 90% are struggling. The bottom 50, those people, they are struggling more because their wages are not keeping up with inflation. But you've taken a look at that and shown
I sense
maybe
a however coming.
However,
Yes.
but
Yeah,
I'm all about the
T
buts,
form
right?
here. Yeah.
But ... You can break down the payroll data, the employment situation data into how much managers are earning, and I think it's a safe assumption that managers earn more than non-managers. And turns out non-managers have actually seen wage growth, payroll, their paychecks grow slightly faster than inflation. In fact, real wage growth, so adjusted for inflation, we're still, for non-managers, wage growth is along the pre-pandemic trend. It's managers that have been held back, which is the yellow line on the previous chart that was there. So, which is interesting. That's something I think that not a lot of people see nor talk about out in the news.
Okay, so let's move from the income side to the actual balance sheet side. Taking a look, income is a stretch from A to B, judging a couple different spans of time, but let's take a look at a point in time and take a look at how people are actually stacking up as far as wealth goes.
I'll chime in on the one on the left then, and we can go. But I mean, so Sonu did this chart, but you're right. So, okay, people maybe are making more than inflation, but do they feel it? How are things really going? We took a look at balance sheets, right? This might surprise a lot of people, but balance sheets, and we don't have it on here, but balance sheets in corporate America, businesses are in really good shape. But balance sheets of households in the United States are in some of the best shape they've ever been. That's what we show on the left here. What is a balance sheet, right? Assets and liabilities. But here's the big thing. I call this denominator blindness. Listen, there's a lot of debt out there. We know there's like over $1 trillion in credit card debt. It's this big, big number, but you need to normalize that by something, right? Because there's a lot of equity out there too. You own a house, you own stocks the last 10, 15 years, you feel a little more wealthy, you probably do. So we normalize it by disposable income, and that's what this chart on the left is showing. Keep this fairly simple. You look at all the assets as a percent of disposable income, it's, what is it, Sonu? It's
736%.
736%. Now, what in the world does that mean?
836% is assets.
Okay, 836 assets. But what in the world does that mean? Well, again, normalized back in the future, going back 25 years, that's some of the best, most assets relative to disposable income we've ever seen. So, Sean, the second side of that is what about liabilities, right? There's a lot of debt out there. Our country has a lot of debt. People, consumers have a lot of debt. What you tend to forget when it comes to the media and the way they talk about this, there's also a lot of wealth out there, a lot of disposable income. Disposable or liabilities as a percent of disposable income right now is right about 100%. You see it there at the bottom. Mm-hmm. It was about 100% in 1999. In other words, there's about as many liabilities now as there was 25 years ago, but there's more equity, there's more wealth.
So if I can challenge you for a second, the stuff that we hear back is, well, that's great, Sean. However, you know, on my balance sheet is my house that's appreciating. I'm only 50 years old and all my 401k assets are appreciating. I can't spend any of that at the grocery store. And is there, from the consumer's point of view, is there a bifurcation? I mean, do you have the people at the top end that are taking care of all the consumers? They're the ones buying the yachts. They're the ones that are going to the steakhouses. They're the ones that are carrying the load as far as the consumption goes. Where the lessers, the people that are lower on the income scale?
I know Sonu have a much better answer than I will, so I'll just set it up like this. I travel a lot. Mm-hmm. When I look around airplanes, I don't think that's the top 10%. I mean, airplanes are packed, okay? Restaurants are packed.
We've seen the TikTok videos.
Yeah, so you can get more in the weeds. I'm going to say from an anecdotal point of view, when you go out and just see what's going on, there are a lot of consumption. I know we can get into the chart on the right, which kind of pushes into this, but Sonu, what do you think about that? Because it's great points.
TSA screenings, the data out there shows that we are at all-time record highs. Right, TSA screening. So that is the, you know,
that's the kind of data you get when you ask Sonu. He goes into TSA screenings.
Yeah, we look at that too.
He just likes to go through that metal detector. Don't fall for that. Man.
All right, sometimes. But no, I think one thing this actually gets to is the way we look at the economy as market people too. I want to be clear. Like at the end of the day, we are trying to invest for our clients, and we're trying to make money, right? But so all of this is in service of that. We're not doing this, because it is fun. Don't get me wrong. But no, we have a balance sheet approach. But you have to look at incomes too, and that's what we talked about before. Incomes have kept pace with inflation, even though people don't feel that. But that's, the reality is, everyone's out there consuming, right? I just looked at the New York Federal Reserve survey yesterday of consumers. If you ask them how much are you going to consume over the next year, how much do you think your consumption will increase? They're talking about consumption will on average increase about 5%. So consumers are saying we're going to spend more. By the way, they're also saying we think we're going to earn more, right?
Are they saving more?
Yeah, actually, so as a percent, so that gets to this chart. That's actually interesting, right? As a percent of the income they receive, they're saving less than they did in 2019. But remember, 2019 was the end of a decade after the Great Financial Crisis. What happened in the Great Financial Crisis? It was exactly the opposite of what happened over the last 3-4 years. Stock prices crashed. Home prices crashed. For most Americans, most of the wealth is in their homes. So what did they have to do? They had to repair balance sheets. From 2010 to 2019, households are repairing balance sheets. The savings rates increased, which is why we didn't see a decade of great growth, right? Because people are saving more. That's not the case now.
Oh, I'll just chime in there. There's approximately $6 trillion in money market accounts. There's approximately $4.5 trillion in checkable savings accounts at banks. I don't know if that stuff shows up in savings rates, because apparently not, because savings rates are down low. I'm just saying when you look around, there are, and I get the argument. This is where I would push back too. Well, is that just the top 10%?
I'll say that
Is it
actually
just the
doesn't
top
show up in the
20%?
saving rate.
And that's why I say it couldn't. So that's, if my math is right on those two numbers, you're talking over 10 trillion, which is a lot more than we were pre-pandemic specifically. But the pushback to that, Sonu, and I would almost like to know your take. If you have $10 trillion and maybe more in money markets and in checkable savings accounts and banks, is that just really wealthy people getting their 5% on at least money markets, or is that spread out a little bit?
That is spread out. I mean, it's not just wealthy people. It does tend to skew, I would say, maybe to the top 40 percentile by wealth/income, however you want to think about it. But at the end of the day, I mean, going back to balance sheets, I mean, if you look at the chart on the right, I mean, the chart on the left actually talks about, again, aggregate, right? Everyone in the economy that can be skewed by the top 10%, top 20%, all of that, right? But then if you break down by income quintiles, right? 0 to 20, 20 to 40, 40 to 60, 60 to 80, and 80 to 99, even the top 1%, everyone's leverage has come down. What does that mean? Liabilities as a percent of assets, that's come down. And it's pretty much close to the lowest we've seen historically. All that to say, for almost everyone across the board, which is not to say I don't want to deny that some people may be hurting, and that's always the case, right? But that's a policy issue.
You broke this down by six different brackets, income percentiles by 6 different brackets, and every one of them, as I look at that, for the most part, are lower than they were a couple years ago.
Yeah, the trend is your friend there.
Yeah.
And to piggyback on what you were saying, right? It was $6 trillion, and this is kind of maybe, I don't want to say it's insurance against a bear market, but that's a lot of dry powder.
Yeah.
That's a lot of dry powder looking for an entry point.
And there's an
to the
old
market.
saying that, cash on the sidelines. You turn on TV, you'll hear some strategists talk about cash on the sidelines. And there really is a lot of cash on the sidelines. But I would push back a little bit against that. I think some people like to know they've got their money nice and safe, getting 4 to 5%, not necessarily looking to put it into the stock market. But if bad times were to happen, if we were to have, again, we don't think of bear market, but if a bear market were to hit, housing prices, people lose their jobs, which we're not seeing at all, to be very clear. But that is some cushion there, clearly, that should help, if we have eventually a recession. We will eventually have a recession. Maybe it'll be fairly minor, because again, balance sheets going into whenever the next calamity comes are in pretty good shape going into it. So that's something we should be comfortable about, I think.
And speaking of cash on the sidelines, the other entity in the economy that has a lot of cash on the sidelines, corporations.
Yeah, right.
Right. And we're already seeing that. Buybacks this year, buybacks meaning they're buying back their own shares. They're reducing the supply. What happens when you reduce supply of anything? Prices go up.
Just to chime in, we can talk all day on this, and we usually do, but last year, everybody talked about a recession. Everybody. We work for Carson Group. We were talking about a recession. Every company was talking about it, and it didn't happen. Was it a self-fulfilling prophecy or not? We prepared for it. We had companies, they got limber, they maybe laid some people off potentially, but they kind of hunkered down getting ready for that recession, and Sean, then it never came. And now we're on the other side of that, so now we're starting to see a lot. I think I have a chart or two coming up, but now we're taking that cash, putting that cash out there, whether it be share buybacks or growing, plants and production. There's ways that cash is getting out there now, creating a lot of economic growth.
Great point. So tomorrow, June 12th, 2024, CPI comes out, and it's Fed Day. So maybe we'll make the transition into the Fed's mandates. Mandate number 1, I guess, is unemployment and managing unemployment. And the other would be inflation. But let's talk about the labor market for a second. What are we seeing in the labor market right now?
We can keep it short. The labor market is as strong as probably, I would say, the strongest we've seen in about 22, 23 years. Okay. Stronger than the last 2 cycles.
So talking points pushback there is, well, what about labor participation? What about those people with multiple jobs? What about those people
part-time jobs soaring?
Part-time jobs. What about that? Or is it really that strong, or are we getting bad statistics again?
I'll take all 3 of those: labor force participation, multiple job holders, multiple jobs, and part-time. So really quick, right? So participation, one thing is we're an aging society. So if you just look at raw numbers of participation, you'll see that falling off, and it's lower than, say, where it was in the 1990s. Where it was in the 1980s and 70s even, right? Why is that? Because a lot of baby boomers leaving the workforce every day, right? They're retiring. I would argue a lot of them are retiring quite comfortably, mostly because stock prices and real estate prices have gone up, right? Sure. Especially over the last 4 years. What we like to look at is, it's called the employment population ratio. The unemployment rate has, it's a very good metric to tell you what's happening with the payroll situation, the labor market in the country, but it's got its own definitional issues as to like who's counted as unemployed, right? The Bureau of Labor Statistics makes sure that you have to be actively looking for work, right? Well, what does actively looking for work mean, right? And like, what if, I have to take care of my kids this week, I'm not sending my resumes out, well, then I'm not counted as unemployed, right? So that's a real thing. There are definitional issues with the unemployment rate. That's why we like to look at the employment population ratio. It's a straight up, it's kind of the opposite of the unemployment rate.
And that's the chart on the right now.
Right, and that's for prime age workers, 25 to 54. That's at the highest level, 80.8% we've seen since 2001. That tells you, well, we joke that everyone wants to work. Is it easy to find a job? I would say it's easier than it was, maybe over the last couple of cycles, the 2000s expansion as well as the 2010s expansion. It's probably gotten a little harder than it was in 2022 and 2023, to be honest. But that was a labor market which was red hot. I don't think it's a red hot labor market. It's strong, layoffs are low. And then coming to the part of multiple job holders. What's interesting is multiple job holders start to increase when the labor market is strong. And if the labor market is weak, it's hard enough finding one job, let alone two jobs.
Yeah, give me one job.
Right, right. And whereas and historically, if you look back at the data, we've seen this, as the expansion gets longer and the labor market gets stronger, we actually see the number of multiple job holders go up.
And it's because they want to get ahead, not necessarily because they're trying.
Exactly.
They're necessarily trying to make ends meet.
And then you talk about part-time. Now, part-time, you have to break it down. There can be good and bad things that can happen with part-time employment going up. One is if you cannot find a full-time job, you accept what you get. You take a part-time job. That's what, actually, it's the term for it with the statistics, it's called part-time for economic reasons. That's actually as low as it has ever been in history. As a percent of the labor force, it's running about 2.6%. Before the pandemic, it was about 2.7, 2.8%, right? That's part-time for economic reasons. People who cannot find a full-time job, they're going part-time. But there's the other side of it, part-time for non-economic reasons. For example, I want to take care of my kids. So I'm going to work only part-time, right? I'm happy with that. Maybe my spouse earns more, whatever it is, right? And that's going up a lot. Again, that happens only in a strong labor market.
Okay, so right now we're almost hit fully employed. The JOLTS number is coming down, and
JOLTS is job openings and labor turnover. Yep. Openings are coming down.
Openings are coming down. So we're kind of hitting equilibrium there. There's supply equaling demand somewhere around there. And with the labor portion solved for, theoretically, as far as the Fed is concerned, that leaves the other bugaboo, which is inflation. So if people are earning more, if their net income is actually improving and they're fully employed and they're consuming, what do you think that portends for inflation? Coming up, and we're gonna.
Sean, that's all right. I'll just wrap up, put a bow on the one before, if you can go back just for a second. So, because what you're talking about here, the idea of, are things slowing down or normalizing? Because we averaged about 400,000 jobs a month back in 22. We made like 5 million jobs that year, even more than that. But a lot of jobs, it's like a record number. Yeah, why? Well, because we're making up for a lot of the jobs lost during COVID. We understand that. But now we're creating well over 200,000 jobs a month on average. So it's not as much as we were doing a couple of years ago. You turn on TV, they say, oh, jobs are slowing, the economy's slowing. You mentioned JOLTS. You're going to have to get too in the weeds here, but that's slowing a little bit. You look at different things, it's slowing. We would argue things are normalizing. In 2019, last I checked, 2019, stock market did good, the economy was pretty good, everything's pretty good. We all know a 100-year pandemic came right around the corner. We averaged, what was it, Sonu? It's up there, 166,000 jobs a month in 2019. Like, that felt pretty good at that time to most of us. And now we're even above that. So we would argue things are not just slowing down, they're more normalizing. And we can get into the weeds of that, but I think I just wanted to put a bow on kind of the employment backdrop and some other things we're hearing about slowing down versus normalizing.
Sure.
And labor demand is demand, right? So how much, how much hiring companies want to do, that's definitely slowing down, normalizing. We think it's normalizing. We don't think it's in a scary place or anything like that. Why? Because they're laying off workers less. By the way, and people are quitting their jobs less. By the way, that's good for productivity.
Sure.
Right? The longer you stay in a
learning
job,
curve.
hopefully
You don't have
you
to
get
hit the
better
learning
at it.
curve. Yeah.
Right.
Everybody quit their job in 22. I did. I quit my job. Thank goodness. I'm glad I'm where I am
And
now.
we're-
I
and
quit-
we're
I
all
quit
the better for
I
it.
quit 2 years ago, right this month. You know, like a lot of people, because you get a lot more money, you go across the street. Now it's not as easy, but people aren't getting laid off, but they're not necessarily quitting either. So you got this nice equilibrium. People have been at a job for a while, and they're starting to really like their job, look at job satisfaction, certain things. Highest it's been in a long time. Those people have a lot more flexibility than they ever did, and that leads to higher productivity, which can lead to better output in the economy.
I'll remind all our support staff that.
There you go. Yeah. So let's talk about
Great deal.
inflation.
So let's go back to
the I
inflation.
word. Yeah.
This was I would say if there was a surprise in the first half of the year, it was really the inflation numbers, right? We got, harder than, I would say harder than expected. When I say hot, 2022 inflation, that was really hard inflation because inflation jumped up to, you can see about 9, well, this is the Fed's preferred metric, PCE inflation, which is the personal consumption expenditures index. It's a little different from the CPI, which is usually coded, right? But CPI hit about 9% in June of 2022. This one hit about 7%. All the state, they were both very high.
The highest since the early 80s, best way to put it.
Exactly. And it's come down now, but it looks like, since September, October of last year, you're not making much more progress. That line is not going down, it's sort of stalled, right? Then the question of why did it stall? And this gets to why we got harder than expected inflation in the first quarter. One was shelter inflation, housing inflation. By the way, in the government's metric of inflation, whichever one you pick, right, home prices are not in there. So when you think, housing inflation, home prices have nothing to do with that. Right, which may shock everyone listening to this, right? No, it has.
It's the government.
Right. Like home prices, but what they assume is like me as a homeowner, I rent to myself. Now, by the way, they don't pick up the phone and ask me, okay, how much are you renting to myself? Because I may give myself a good deal, right? So
I just wish someone would come around and fix my dishwasher. Anyway.
that too, that may be expensive though. But that gets to a hot labor market. It's a whole other thing. But no, they don't pick up the phone and ask me like, Sonu, how much are you renting your house to yourself for? No. They look at prevailing rents. Prevailing rents, so in my case, single family home in Chicago. Yeah. All of that housing inflation is actually rental inflation, right? And rental inflation really surged in 2021, 2022. Why? Because people are moving around a lot during the pandemic. A lot of people left cities. They moved to the suburbs. They moved down south to, Texas and Florida and places like that. But that movement was happening all over.
But it seems to me that there's a kind of a vicious cycle embedded in that, because if shelter is supposed to be a very high contributor to what was a hot inflation number for the first quarter, I mean, you're asking the Fed to thread this needle where shelter is high, or well, inflation's high. Why? Because shelter is high. Why is shelter high? Shelter seems to be very interest rate sensitive. Interest rates are high, but that they're trying to keep inflation low, but inflation's high, and you keep going around this.
And you've hit the irony that the Fed is trying to, it's sort of counterintuitive, but what the Fed is trying to do is, look, if you raise interest rates enough, other prices will go down. For example, the price of used cars, new vehicles, as labor demand, which we just talked about labor demand, that's falling. So maybe people will earn slightly lower. Instead of getting a 5% raise, which is what they were getting in 2022, they may get only a 2.5%, 3% raise.
So I want to ask a quick question here, because we do have some clients that are concerned about with all this inflation, with this runaway, and we all see it. 20% is not insignificant over the course of the past 4 years. But now they're starting to question, well, the strength of the dollar, the value of the dollar on a global stage. Are we going to see the dollar collapse? I mean, there are doomsday scenarios out there that not unreasonable people will come up with. But what's your take on the strength of the dollar?
I'll chime in.
Globally?
You can come in there. So the dollar actually was fairly strong this year so far. So we haven't seen that yet. I want to be very clear. Starting to weaken a little bit here, but big picture. The U.S. has a lot of debt, right? That's the argument. There's a lot of debt out there, deficits, potentially, if some bad things happen, the dollar goes lower. There's some talk that different countries are getting together, China, Russia, some of our, not so much our friends, getting together with some currency things happening behind the scenes, maybe behind the scenes, maybe in front of the scenes. I'll just say this, currency wars have been happening for as long as there have been currencies. So that's nothing new. To me, when I look at the first half of 22, we talked about that, it was a vicious bear market, yield soared, bonds didn't do well, wasn't very good. The US dollar was about the strongest asset out there. So what I'm talking about is when the you-know-what hits the fan, people flock to the dollar. March of 2020, people don't remember this until you look back at it. Stock market did terrible, we understand that. Bonds didn't do very well. Even gold, so see the safety thing, gold sold off in March of 2020 when the pandemic was really bad. Yeah. The US dollar, the cleanest shirt in the dirty laundry, was the strongest thing out there, by far the strongest currency out there, March of 2020. What I'm getting at is when there's stress in the system, and we're gonna have stress in the system again, if people don't flock to the dollar, it'll be the first time in like a generation that didn't happen, and that will worry me. So we are aware of all these problems that are out there, but again, I just think we have the cleanest shirt in the dirty laundry. Hopefully, as long as anyone's listening to this very discussion, we're gonna have the world's reserve currency, and you can get into the weeds of different channels or what different people are saying on different things. It's an election year, so of course everything is hypersensitive. But no, we still think the dollar is the world's reserve currency, and that's not going to change. A little gently trending lower dollar, that's not the end of the world. That's usually pretty good, actually. When the dollar's strong, usually means, hey, risk assets are kind of shaky. People are buying the dollar for safety. So that's something to remember until that changes, which I don't think it's going to anytime soon. We'll see. What do you think about that?
I was going to say I have never been more, I'm going to say this cautiously, optimistic about the dollar's prospects. And with respect to markets, you never want to be too optimistic about a dollar because a strong dollar can sometimes hurt markets. Yeah. But in terms of going back to your question on the dollar's prospects, why do you think the dollar will be fairly strong, not just the next year or 2 years? I mean, short term, you never know what can happen, or the next decade, 2 decades. We are very optimistic about the U.S. economy. Ultimately, I think the dollar relative to other currencies comes back to relative economic growth. And we are more optimistic about U.S. economic growth than we've probably ever been, and especially relative to other parts of the globe. You look at China.
The real estate bubble imploding as we speak.
Right, and we talk about debt in the U.S., including government debt. China's debt is about, if you take public debt, private debt, all of it, it's about above 300% of GDP. Everyone talks about US debt. Like, no, China debt is a massive problem. So they're having to slow their economy down. So they have issues. Europe, we all know they've had issues, especially demographics, things like that. I mean, the US, we are very optimistic about economic growth over the next decade for the US, and I think that's going to keep the dollar strong.
And this is a good segue into the strength of US corporations.
Yeah, and I'll just kind of weave the two together. So we have $34 trillion of debt, right? At most we've ever had in our country. We're aware of that. Now, there's been, for generations, talk about all the U.S. debt that's out there. There's a Newsweek cover, I think in 71 or 72, with Statue of Liberty crying, talking about the U.S. debt implosion and all the trouble that's going to come. I mean, the truth is, John Connally, when the U.S. dollar was pegged to gold in, I think it was 71, 72, the U.S. severed that. In a room full of bankers, John Connally was the Treasury Secretary for Nixon at the time. And he said, a room full of bankers, he said, you know what, it's our currency, but it's your problem. I'm not saying it's right. I'm not saying it's wrong. I'm just saying when you have the world's reserve currency and you have that attitude like we've had ever since, we have a lot of debt, but we still have the world's reserve currency. So can you play by a different set of rules with the world's reserve currency? To a degree, you can. And that's kind of where we've been ever since. That denominator blindness discussion I started a way long time ago. Yes, $34 trillion of debt. I grew up in Ohio. My dad owned a small business, he owned an auto parts store. I didn't grow up thinking, let's just have a bunch of debt. My dad didn't have a bunch of debt. I promise you, I only had a credit card. He paid cash for everything, So I grew up thinking that way. So I'm not crazy about all the debt we have, and I know a lot of your clients and a lot of people aren't either. But when you look, that's the U.S. debt. When you look at corporations debt, like we talked about, when you look at consumer debt relative to what they're worth, things really aren't as extreme as they've been, Sean. What matters more, I think, to investors, now we can get to the screen here, corporate profits. I mean, corporate profits have been soaring lately, 12 months out. Let's show on the left, this 12-month guidance, what the S&P might do. And I get that's guidance. That could change, right? That's forward guidance. But it's been really strong. Earnings this year expected to grow maybe 11% on the S&P 500, hit all-time highs. We think that might be a tad low with some of the bullish things we've talked about. But on the right, profit margins. We've been told for years profit margins are going to be pushed lower. Profit margins are going to be in trouble. Corporate America has been lean. I talked about it already, getting ready for that recession. It never came. We got lean, and now we're getting to the other side of it. So profit margins are staying strong with all-time high earnings. Those matter more for clients, people listening to this, probably for how the stock market is going to do versus all that debt that I'm not crazy about.
Are they sandbagging? are the guys who are giving guidance to the analysts sandbagging?
Only as much as they've ever been.
Yeah.
And which is why you compare it to history, right? And that's why you compare it to the trend. Going back to your question about sandbagging, it's a great question, and there is that, right? There is that sandbagging, but not more than they've ever done.
So, when we see these highs, and we talked about the highs a little earlier, now we've got this great slide here where we talk about bubbles. Is this a bubble? Can we have a bubble with $6 trillion of cash on the sidelines? What do you say about the valuations that have come in over the past year or the past 4 years?
I like this because when you talk about market returns, if the market's up, say 20% or 25, whatever the numbers are, if the market's down, how does that break down, right? And this is what we've done in this chart here. We can break that down into three pieces. How much of it comes from dividends, right? Which is what corporations pay out, every quarter or semi-annually, whatever the case is. How much of it comes from profit growth, right? We just talked about profit growth. That's been strong. But there's also valuations, right? How much should I pay today for, how many dollars should I pay for a dollar's worth of future earnings, right? And that gets to a lot of the stuff he does. I mean, why do we look at charts? Because that gets to sentiment. That can move, people can be over optimistic, under, pessimistic, whatever it is. If you look at the chart, like 2020, 2021, see, most of those years have been positive. These show market returns. In 2021, for example, the market is up 29%. Most of that came from the green bar, which is profit growth, right? Valuations actually fell. Valuations were a drag on returns. But then you look at 2022, the market is down.
This is the one that I found very interesting.
Yeah, 2022, markets are down 18%. The S&P 500 is down 18%. Corporations still pay dividends, by the way. Profits actually went up. But then the drag was valuations. People are pessimistic. Right?
There were wars going on, higher interest rates, higher inflation. It just wasn't a good time for investors.
Sounds like a great buying opportunity.
Looking back.
Looking back.
Every day is a good buying opportunity going back to.
Well, that's just it. Now we have to think about moving forward. What are the value, or where are those spots? Well, I'll just advance it a little bit.
Okay.
Where are the spots of opportunity do you see? I mean, I don't want to say rose-colored glasses because I don't think that's appropriate. There's a lot of analysis going behind your optimism. But if that rising tide is raising all boats, is there anywhere that you think maybe some boat's going to get a little higher than others?
Yeah, the honest truth is the market is a little pricey. If you look at the aggregate, everything, okay, the market is pricey. And why this chart, I think, sums that up. Growth stocks, large caps that make up a huge part, obviously, of client portfolios and the market in general. Those are a little pricier. We know some of the big tech names have done amazing and have had tremendous earnings growth to boot. But again, as investors, we want to be invested in those, yes. But we also want to look again, maybe there's other areas that are underloved, that are underappreciated, that potentially could be a good value right now. And when I say that, maybe it's for the next 5 years, next 10 years. There are some parts that are cheap, and specifically U.S. small caps. Developed international, we don't like that quite as much. U.S., I know you don't either. Small caps and mid caps are historically cheap, especially relative to large caps and where they are right now. So those are two areas that we look at as this market broadens out. What's that mean? It means more participation. If you look at earnings growth, Sean, the second half of this year and really the first half of next year, it is expected that S&P 600, that's small caps, that earnings growth is going to be exponentially higher than what large caps. Large caps have been all the earnings growth the last, I don't know, year or two, it feels like. It feels like a while. But we're finally going to see a lot more earnings growth. So again, it doesn't mean go all in on small caps or mid caps. But we are saying maybe there's an opportunity to potentially look at this and find some things on the cheap. Doesn't mean it's going to go up the next month or two, but 5 years down the road, small and mid caps might do really, really well. Last comment on this, if you look at, again, a little geeky, but if you look at small caps relative to large caps, Valuations. Small caps are as cheap as they've been relative to large caps since 1999. There was a 13-year period where small caps outperformed large caps the last time they were this cheap. I have no idea if that's going to happen again, but history doesn't repeat itself. It often rhymes. Mark Twain, we've quoted him again. There's another one you mentioned earlier. You saw it on the internet. I was going to joke about the Mark Twain quote. You know, Mark Twain said, "Be careful about everything you read on the internet." You know, anyway, nonetheless. But there are some cheap parts of the market out there. And again, sometimes things are cheap for a reason. Let's be very clear. I mean, developed international, you know, we've seen emerging markets. They're cheap for a reason sometimes. But overall, I think that things look good. I mean, why do you think small and mid could do well the second half of this year?
Because I know you're not a reversion to the mean guy. It's going to go up just because.
Yes,
because
yes.
on
I
average.
mean, there always has to be some basis for it. But look, valuations, I should be clear that ultimately, what are we measuring? We're measuring sentiment, to be clear, right? How much are you willing to pay again for future earnings, right? And people have been pessimistic about, you know, most parts of the market except tech stocks and growth stocks for obvious reasons, right?
Yeah.
We won't mention the names here, right? So that this clears
we-
compliance.
We know who they are.
I think we know who they are.
Yes. But, and this also gets to, you know, you just asked, like, why do we think these parts of the markets, the unloved parts of the market will come back? I mean, earnings growth. And that gets to what we talked about before. You know, when do you have earnings growth? If you're confident about the economy, and that we are. Hopefully, you know, we've laid our case for why we think the economy will continue to grow strong. I mean, mostly on the back of a strong consumer, but also, you know, fewer headwinds that we've seen, like housing will come back if the Federal Reserve drops interest rates. We think manufacturing will also come back. But this also gets to why you want a diversified portfolio. You don't want to, when we talk diversified portfolio, everyone always thinks, oh, it's stocks versus bonds. Yes, that is one way to diversify things. But even within stocks, you don't want to bet all into one side of the
Don't
market.
chase a shiny object. Don't
Right,
always go for the
yeah.
top performing mutual fund or stock that year because it probably won't be the next year.
Exactly. Like we like mid-cap stocks a lot. Now, you want to diversify across that. You talk about the, I mean, I don't want to say, I want to be clear that we don't think this was a bubble, right? But if you go back to the dot-com bubble and the following crash, what's interesting is that mid-caps and small-cap stocks from 2000 to 2003 did much better than the overall market. Right? Again, this is why you want
Value
to
stocks did
diversify.
pretty well too.
Value
I mean,
stocks,
especially relative to growth.
I mean, you know,
I mean, what do you think about commodities or, you know, all non-correlating assets? I mean, understanding that those things are not fit for every investor out there, and you know, you need to talk to your advisor, which I would recommend that everybody does on a very regular basis. But again, I mean, there are other assets out there that you can diversify across that are just not stocks or bonds.
Yeah, and I would put it this way: you want to diversify even your diversifiers. We learned the hard way. If you bet all in on one form of diversification, which is bonds, that can hurt, especially when inflation's high and the Federal Reserve is raising rates.
We learned that in 2022.
In 2022, and then in the 70s. I mean, you know, we weren't alive then, but
Okay, so-
but yeah, no, you want to diversify your diversifiers. That's all.
So
I'd say.
again, I think we've established through the course of our conversation, which has been great, by the way. We've learned that, you know, you guys are very bullish. You're not perma bulls. I wouldn't put you in that camp. I mean, you're smartly bullish. Where are the bald spots on these tires? I mean, are there any bald spots? What are you looking for? What are you on guard for?
So hopefully I can use the F word. Am I allowed to use the F word on this? The Fed.
ahead.
The Fed. We've talked about the Fed before. So that is one worry we do have because we look at the inflation data. We don't need to get into it anymore. We think there's some positive trends on inflation, whether you look at used cars, you look at shelter, you look at financial services fees, our world where, hey, stocks are up, so there are a little more fees when you look at inflation. Those things are going to improve the second half of the year. Yet every time I hear about the Fed, they're talking about they need to see more data. They need to see more data. I'm not so sure if they really need to. So what I'm getting at is a potential policy mistake would be one of our big worries second half of this year. If inflation continues to improve like we think it can, but the Fed doesn't think they need to cut, they're going to leave rates up here. That could upset the apple cart. We don't
So-
expect that to happen. We'll be clear, Sean, but that's one worry of ours.
So what does the Ryan and Sonu dot plot look like? I mean, what are you guys thinking for the rest of the year?
We should do that. Trademark the Ryan and
Yeah,
Sonu dot plot.
plot. I like that.
Two people might look at
It's
it.
on tape. I was the one who get.
June 12th.
Two people might look at it, or three people. Three people might look at it, but anyway, I'll lay it to you then. I mean, do you think there's probably not going to be a cut tomorrow when we do that? We're comfortable there, but could September be on the table? You think?
I think so. I mean, the Fed likes to say they're data dependent. And I think it's safe to say, I think they are. Now they will say, and we'll probably hear it tomorrow being June 12th, right? Which will be in the past by the time you all see this video, but that's how these things work. But no, they're going to say we need more confidence in the inflation data. I think, as we've talked about, we're kind of already there. We have the confidence in, we're not seeing anything in the economic data that leads us to worry about inflation going up again, right? And we think it's not too far from the Fed's target as well. There are idiosyncratic things that are keeping inflation elevated, like shelter, but I think that's more of a measurement issue as opposed to anything that's actually happening in the economy, right? So we think the Fed could cut maybe twice this year.
Do you think they'd do it that close to the election in September?
So it's interesting as you look in history, it is rare for the Fed to do anything. We looked at 94 with some reliable data. It's rare for cuts or hikes ahead of an election. Are those random years or is it, we don't want to be political? But we think they could. I mean, they can. Now, the last time they cut in front of an election, I'm talking 3 months before an election, was 2008, October 2008. Well, the wheels are falling off as we know back then. But we do think so. And it's good. We got a couple more inflation data pieces and we'll see. But and let's be very clear here also. Clients are going to hear this whenever they start to cut. Well, last time they cut was the financial crisis before the pandemic, then the financial crisis, then 2000, right? I mean, they cut usually when bad things happen. But if you go back further, Sean, you can have what we're going to call more of a surgical cut. And that's kind of like a mid-90s scenario where 1990 recession, economy did well, Fed hiked a lot in 94, upset the apple cart. Orange County, I know out here, Orange County went under in late December of 94. Remember last year when the Fed hiked a lot, or they hiked a lot 2 years ago, but then in March, obviously Silicon Valley Bank, some banks went under, history doesn't repeat, but it rhymes, said Mark Twain.
Seems like it always happens in California.
Yeah, that's true. Things kind of wobble a little bit, but then they can do a couple surgical cuts. And in 95, when they did that, I mean, obviously people hopefully remember, the economy did very well. Economy took off. Not saying it's going to be like that again. But the last point on this, 3-4 months ago, people were saying 6-7 cuts this year. We looked at each other saying, if we get 6 or 7 cuts, that probably means the economy is really slowing down. The work that I did, work that Sonu did, we said, no, there's not going to be 6 or 7 cuts because the economy is still strong. We were thinking maybe 3, maybe 4, but probably more like 3. Now we're in the 2 camps. September, November still makes sense. More surgical cuts, a la kind of the mid-90s, and that should be hopefully a good sign.
And I think the Fed will want to show their independence, especially the more people say, and I want to condition on, they will be conditioned on the data, right? Always say, if the inflation data cooperates, come September, there's the question of, it's too close to the election, and they're not going to do anything. But I think the Fed will likely want to show the fact that, I don't want to say they're going to say, put it this way, like we don't care about the election, but it'll be like we don't care about politics. They're going to do our own.
We're apolitical.
In theory, they're not supposed to, and they just look at the data. And let's be honest, they hiked rates from 0 to up 5.25. What's one more 25 basis point cut in the whole scheme of things? Not that much, more symbolic than anything.
So why don't we end up, because we've had a very robust discussion here, and we'll just end up where we began. It's an election year. Mm-hmm. And with everything going on, despite what side of the aisle you're on, you can cheer and root for whatever home team you want. What does the data tell you about who's in office and how they're doing?
I know we've got some other charts that looks at kind of how the House and things are divided, which matter more, but we'll just focus on this. Yes, historically stocks have done a tad better under Democratic presidents and Republican presidents, but I want to be very clear here. Just look at these returns, right? Look at you had some, George W. there, and I guess really his 2 terms. And what's the other one there? That's Nixon obviously didn't do well, but overall, you tend to see gains, again, if what happened, by the way, recession, 73, 74 recession, if the economy, like I talked about earlier, if the economy is strong, it doesn't really matter who's in the White House. And I know that kind of upsets people because people have a certain feeling about who might be in the White House, or who's in the White House now, who's in the White House, come November or so. But Sean, if the economy's strong like we've laid out, we still think it suggests, again, that stocks can do just fine going forward. And we can get into more of the weeds, what I think matter more the next slide or two, but that's kind of where we see that. Yeah, here we go. This is where I kind of want to go with this. Yeah, this is a go. It's not about...
I'm glad you asked.
Yes, how about that? Yeah, the joke, I said, it's not about red, not about blue, it's about green, right? And here's what I mean by that. Yes, stocks have done better historically under a Democratic president than a Republican president. Not by a ton, but by a little amount. But stocks have actually done a good deal better when the Republicans control both chambers of Congress versus when the Democrats control those chamber of commerce. So I'm kind of giving something for everybody here. But here's what really matters in November when we wake up. When you have a divided Congress, like we do right now by a very small margin, I think the House is like 2 or 3 seats. It's not many. It was 5, but
It may be 1, depending on who's on vacation.
well, exactly. So we have a very small majority right now for Republicans in the House. Democrats at 51-49 in the Senate. That is about as gridlock as you can get. Sean, the last 12 years, we had a divided Congress. Take a wild guess what happened. The S&P 500 was higher. This year's looking like number 13. When all is said and done in November, we think this is not necessarily our base case. We follow a lot of smart people in Washington. They could be a flip-flop. The Republicans might take the House by just a little bit, but the Democrats take the Senate.
The Republicans take the Senate,
Thank you.
Democrats could
Yeah.
take the House.
Yeah.
Well, the presidential election seems like a coin flip, could go either way.
But we're probably still going to have a split Congress. At the very least, it's going to be very close. And why does that matter, right? If you have a major blue wave or a major red wave, you can get more extreme in what the government potentially does. Market doesn't always like that. Look at some of these global markets, Mexico and India,
yeah.
where you're getting some of the election results people didn't expect and some big sell-offs because the market doesn't like uncertainty. When you have too much power, not checks and balances like our forefathers wanted, that's when things can come in. So what I want to point out, when the election happens, we wake up the next day, we might not even know who wins the election. Let's be honest, we might not know that immediately. But we will eventually. If we have still a fairly divided government, that is what investors should hopefully be comforted by, is what I want to say.
Gridlock is good.
Gridlock is good. And
One policy
Yeah.
swing one way or the other.
Yeah.
Like we saw with the Mexico election, there was a big wave, and suddenly markets fell. Why? Because they thought, oh, policy is really going to change.
If the opposite of pro is con, then the opposite.
Nipsey Russell.
There you go.
Nipsey Russell.
Then the opposite of progress must be Congress. There you go. There you go. That's something you can use all year when it comes to these things. And what's the other one Reagan said? The 10 most dangerous words. Hi, I'm from the government and I'm here to help. That's another one.
There's
So,
5,
there you go.
but this time it's different.
Yeah.
Yeah, that too, yeah.
Well,
So,
guys,
I think we've got one more. Do we have the last one about or no? The bespoke data? I can do that.
No,
okay,
no,
let
we
me do
didn't,
that
we didn't get that
I'll
one
just
because
say
this
it.
is
That's a good way
important.
to-
Bespoke had, you
Yeah.
guys have run into this, I think it was not a partner summit, it was the Excel that they were out there that they presented us. Really interesting. Listen up, folks.
Yeah, so if you started 1953, Eisenhower, first term, and you had $1,000 and put it in the S&P 500, which in theory you can't even do, you couldn't even do that back then, but this is in theory, $1,000 in the S&P 500, only invested during the Republican, when a Republican was in president, you'd have approximately $28,000, $29,000 right now. Right? Actually, at the start of this year, is what I should say. If you took that same $1,000, only invested in when a Democrat was president, you have about $56,000, $57,000. Again, a little bit better return. Honestly, it sounds like a bigger deal, but the return's just a little bit better each year, compounded. We understand the way compounding interest goes. So you got about 25, 26, 27,000 Republican. Maybe call that double that or so for a Democratic president, a little bit more. If you just stayed invested with that same $1,000,
Kept
you'd
your
have
hands in your pockets.
It didn't pay attention to the government and what was on Fox News here and CNN there, and just stuck invested. Sean, you'd have 1.7 million.
And
That's all we gotta say.
And that is
Yeah.
the mic drop.
Yeah.
That's the important thing. It's not timing the market, it's time in the market.
There you go.
Guys, this has been great. Thank you so much for coming out. I've really enjoyed chatting with you. Hopefully the clients have enjoyed hearing someone besides my talking gob. And I really enjoy hearing what you guys have to say. And your podcasts are amazing. So, guys, again, thank you for being great clients. Thank you for supporting us. And thank you for allowing us to serve you and your families. There's no greater honor that any of us do have. And if you do have any questions about anything that we talked about today, please, please, please contact your advisor, set up an appointment, and let's chat. And again, thanks for tuning in, and we'll see you likely in another 6 months. God bless.
Wow, was that a lot of information? Thanks, guys. That was absolutely terrific. Now, people, remember, your friends, your loved ones, your neighbors, they can get a free consultation. They can sit down with us. We'll review what they have. We'll give them an unbiased opinion, a second opinion, if you will. And it's up to them if they choose to use us or not. But call the 800 number and set up an appointment. The phones are standing by, so we look forward to meeting you and helping you if we can. Thank you. Make it a great day.